Most people think investing today is easier than ever. No commissions, instant trades, unlimited information. You can open an app and buy a stock in seconds. 30 years ago, you had to call a broker. I paid over $100 in the mid-90s just to make one trade. So investors today should be doing better than ever, but they're not. In fact, the more people trade, the worse their results tend to be. So what changed? Because it's not access, it's not cost, and it's not opportunity. It's behavior. And by the end of this video, I'm going to show you a simple plan that helps you avoid the trap most investors fall into today. 30 years ago, investing had friction. Every decision cost money, so people slowed down. Before buying, you had to ask, is this worth paying $100 to get into? Now, luckily, Charles Schwab came along and it dropped to about $30 a trade. Still, that alone filtered out bad decisions. Today, that filter's gone. Now you can buy, sell, change your mind, react to a headline instantly. What changed? People didn't become better investors. They started making more decisions. And that's where the problem starts. Stocks don't move on good or bad news. They move on whether it's better or worse than expected. And that's a completely different game. A company can report strong earnings, grow revenue, look healthy on paper, and the stock can still drop because the market already expected it. That future was already priced in. So when the news comes out, nothing changed. Now, think about what that does to behavior today. You see a headline, you react, you buy, you sell, but the market is reacting to expectations, not just the headline. And you're making decisions on information that's already been processed. Today, you're exposed to everything, every earnings report, every price move, every opinion online. And because trading is so easy, you can act on all of it. The system went from limiting decisions to encouraging them. As activity increases, returns tend to go down. More decisions equal more chances to be wrong. And most of those decisions are made under pressure with incomplete information influenced by emotion. No doubt the system is better, lower cost, more access, and certainly better tools. But the guardrails are gone. And what replaced them? Responsibility. 30 years ago, the system forced discipline. Today, you have to create it. So who actually benefits? It's not the most active investor, it's the most disciplined one. And here's what this looks like. This is the plan. I'm just going to touch on it because later I'll have a video where I go more in depth. But this is not theory, this is something you can actually use. First, define your objective. Not make money, something specific. Second, build a core portfolio. Long-term positions, strong businesses that you're going to hold through volatility. Third, define how you buy. Set your price, set your size, set your conditions. Now you're executing, not guessing. Fourth, define when you sell. Not based on price movement, based on fundamentals changing. You may find yourself way up in a position and thinking of selling it all. I've been there. One thought, though, may be to sell a portion. Offset your original purchase price. I've never seen anyone lose money by taking a little bit of profit. Fifth, limit your activity. Because discipline today isn't about knowing what to do, it's about knowing sometimes when to do nothing. Six, build a watch list. Prepare, wait, don't chase. Seventh, accept volatility ahead of time. Decide before it happens. This removes reaction, emotion, impulse, and replaces it with structure, patience, control. Investing got easier, but it also got easier to make mistakes. The advantage today isn't better information, it's better behavior. If you got value from this, subscribe. Everything here is built to help you make better financial decisions without the noise and without the mistakes most people don't even realize they're making. And I'll see you in the next video.